A credit card is one of the best tools you can have to build your financial life and your credit. And it is simultaneously also one of the absolute worst things that you can use, depending on what type of person you are and your understanding of how credit works. Simply put, the good way to use your credit card is to use it as much as possible, pay it off fully, right on time, preferably early, and over time build your credit. And depending on what type of card it is, if it gives you rewards and stuff, then great, but that's secondary. The bad way to use it, that unfortunately a lot of people do, is they use it thinking that their credit limit is the money that they have, and they buy things they can't afford, and then they just pay the minimum or sometimes not even that, and then they fall victim to the crazy interest rates that credit cards come with. Based on the Federal Reserve data, Americans owe roughly $1.25 trillion on credit cards, and the average rate is like 22%. Look at all the money these big companies are making. Look at their valuations for Visa, MasterCard, American Express. That's all from earning money on interest that people are paying by using their credit cards. So it's not about whether credit cards are a good thing or a bad thing. Like any other tool, it depends on how you use it and your knowledge of how it works. So essentially, a credit card is basically a revolving line of credit. So when you get a credit card from a bank, they're basically giving you permission to borrow up to X amount of money, usually per month, and that's going to be considered your credit limit on that card. So when you tap your card and you buy something, it's essentially the bank that's digging into that credit limit, paying that merchant or the seller, and now you owe the bank whatever they let you borrow. When you repay them what you borrowed on time, that credit becomes available again. So if you have a credit limit of, let's say, $5,000 and you buy something for $1,000, now you only have a credit limit of $4,000 to spend, but as soon as you pay off that $1,000, it resets to $5,000. And that's why it's called a revolving line of credit, because you can borrow, repay, and borrow again without having to apply for a new loan every time. In comparison to a debit card, which is going to pull money out that you already have out of your own account. A credit card is temporarily going to use the bank's money and essentially create a debt in your name to the bank for that same amount. And the reason to break it down this way is to understand that your credit limit is not the money you own. Just because you have a $20,000 limit doesn't mean you can afford to spend $20,000. Sure, that transaction will go through, but it doesn't mean that based on your finances, you have enough to pay it off. The bank might be comfortable lending you $20,000, but that doesn't mean anything. For them, they're going to make crazy interest off you if you can't pay it back. So just because you have a credit limit doesn't mean you should be spending anywhere close to the maximum. You should only ever spend what you actually have or what you have coming in that you know you can afford. And if that's too difficult for you, then stick to debit cards. Don't even touch a credit card. Now let's talk about some timelines. There's the purchase date. So obviously when you made a purchase, let's say in this case you spent $1,000 on July 5th. And then there's the statement closing date. So that's going to be for that particular billing cycle. Usually it runs about a month. But in this case, let's say the billing cycle closes on July 25th. And the bank issues you a statement letting you know that you owe them $1,000. The due date is usually 3 to 4 weeks from that closing date. So in this case, let's say it's August 15th. And then the payment date is when you make the payment. And this is the key right here. If you're going to use a credit card to your benefit, you should be paying off the full amount that you owe before the due date. And what that allows you to do, you basically just use the bank's money for free, interest free. Maybe you got some rewards out of it with your card. You paid it off, you built your credit, no problem. And that period between the statement closing date and the due date is the grace period. And that's the entire advantage of using credit cards. It's allowing you to build your credit for the future. And like I said, if you have a credit card that gives you rewards, then you're also enjoying that benefit. Now let's talk about some of the numbers. In your bank app or in your online banking, you're going to see usually these numbers everywhere. Your statement balance, that's going to be what you owe based on the last billing cycle that already closed. So this again is the number that you're paying in full before the due date to avoid any interest. Your current balance, just like what it sounds like, is what you owe right now, including purchases that you've made after the statement closed, minus the payments or any kind of refunds you have. So you don't need to pay this full amount by the due date because some of it is going to be on the next cycle. You just need to pay the statement amount before the due date. So let's say your statement balance was $1,000 and you owed that on July 25th. And right now it's July 15th and you spend another $1,000, you only owe $1,000 before the due date. That next $1,000 is going to belong to the next statement. The minimum payment, that's the smallest amount that you can pay the bank that's due. So bare minimum, you have to pay them this amount. I would recommend that you don't even pay attention to this because you should not be bothering paying the minimum amount because you're going to get charged a ton of interest on the part that you don't pay. So again, this is not how you use a credit card. This is just for educational purposes, but don't even focus on the minimum payment. Your job is to pay the full payment before the due date. And then your available credit is basically your credit limit minus what you've already used. So if you have a $10,000 limit, you've used $2,000, then you have $8,000 available credit. Now let's talk about the key thing that makes all of this work, and that's interest. So the APR is the annual percent rate. So usually for credit cards, this is going to be somewhere between 20, 22%, even higher. So let's say, for example, it's 21%. Now, banks are smart. They're not going to wait all the way until December and then charge you 21%. Most of these credit cards, they're going to break that down into a daily rate and then charge you every single day if there's a balance owing on your account. So if it's 21% divided by 365 days, you're roughly paying 0.05% every single day. So for example, if you have a $1,000 balance that you didn't pay back before the due date, you're now paying $17.50 in interest on top of the $1,000 that you already owe. So now all of a sudden, just for the privilege of using that money for a month and carrying that balance, you now owe the bank $17.50 on top of the $1,000 that you already owed. And over time, this starts to compound, and then it's just like a big snowball. It gets worse and worse and worse. So do not ever fall for the trap of spending money that you don't actually have, that you can't actually pay back. It can destroy lives. And that's why minimum payments are such a problem, because if you're only making minimum payments, every single month you're going to owe more and more and more over time, and it's going to compound on itself, and chances are you're going to continue to spend and find yourself in a very bad situation. Now, like we talked about earlier, if you look at these credit card companies and their stocks, they're doing very well. So how do they actually make money? A lot of credit cards give you rewards. So how do they afford to do that? The first thing is interchange. So every time you use your credit card, that merchant or that seller, that cafe, whatever, they're going to pay a fee to the credit card issuer. Usually it's like 1 to 3%. So they make money off of that. The big thing is interest. The people who don't pay their amounts in full before the due date and they owe interest to the credit card company, that makes up a huge part of their revenue, almost all of it. And then there's the fees. You notice some credit cards have annual fees, especially the ones that have the good rewards. And that's another contributor to these credit card companies. So keep that in mind. Rewards aren't just coming from nowhere. These credit card companies have to make a ton of money in order to hand out those rewards and entice people to sign up for their cards. And unfortunately, what often happens is the people who are smart about their credit card use, they're the ones who benefit from the rewards. Meanwhile, the people who aren't very good about it or don't know what they're doing when they're using a credit card, they're the ones who end up paying for it all. And the key thing that we've mentioned is that credit cards can help build your credit history for the future. Let's talk about how they do that, because that's the most important part, because if you use it inappropriately, they can also destroy your credit for the future. So they're going to look at your payment history. So all the credit cards that you have, mortgages, car payments, they're going to look at, did this person pay on time? Did they pay in full? And they're going to factor that into their scoring. Missing a payment, paying late, paying less than the full amount, all of these things are going to lower your credit and your payment history quality. This is why, if you can, setting up automatic payments and pre-authorized debits is usually a good idea. In case you forget or you forget when the deadline was, it just solves that problem for you. And then the other thing is credit utilization. So this is the amount of money that you're borrowing against your limits. So let's say you have a $10,000 limit and you're using $2,000. Your utilization there is 20%. And simply put, lower is better. Just because you have a lot of credit doesn't mean you should be using up to the max. It will affect your credit score. So whenever you apply for a mortgage or a car loan, this is the type of stuff they're going to be looking at. Hey, how much credit does this person have available to them, and how much of it are they using? The lower that amount is, the less of your available credit you're using, the better. And then the other thing is account age. So older accounts, more steady credit profiles, that's going to help improve your credit score. And this is why, if you're going to use credit cards the right way, everybody should have a credit card as soon as they're eligible to get one, so they can start building that history. And this is also why you might hear people say not to close credit card accounts, because it can shorten your credit card history and cut your available total credit, which again is going to bump up that utilization amount. This is also why you shouldn't apply for a bunch of credit cards or mortgages or loans at the same time, for those same reasons. But again, this should illustrate to you that the key is to educate younger and younger people on the proper use of credit cards. Get your kids these credit cards, teach them how to use it, and then over time they're going to look up in 10 years and have a great credit score and be in a very good position. And just so you know, in order to build your credit, you don't need to be paying interest. As long as you're paying off that amount before the due date every month, that's going to build your credit. Don't think that you need to overspend or carry balances in order for it to contribute to your credit score. That's going to make things worse. Now, it's also not an emergency fund for you. Just because the transaction goes through and gets you out of a pickle doesn't mean that a credit card should be serving as your emergency fund. A proper emergency fund is money that you already have. If your car breaks down and you put the repair on a card, that's fine as long as you can pay it before the due date. But if you don't, then you just solved the car problem and created yourself a huge financial problem. So basically, all that is to say, credit cards can be a great tool, but make sure that you use them and don't get used by them. Set up your auto pay, make sure the full statement balance is being paid before the due date. Basically, in your mind, just treat your credit card like your debit card. Only use it for things that you can genuinely afford, that you can easily pay off, even at the same time if you had to. Don't chase rewards. If you're genuinely going to be spending and the rewards are a nice side effect, great. But don't fall into the trap of annual fees and increasing your spending just to get rewards. It defeats the purpose. And if you're ever in a situation where it's too difficult for you to pay off the full balance, it's just not working out for you, stop using credit cards. Just go back to debit cards until you can sort out your financial situation. So that's pretty much it for this one, you guys. Be sure to check out the description for the newsletter and the resources that we're working on. Everything's free. This is all just stuff that I wish somebody had taught me when I was younger, and I hope it helps you out. Let me know what you want to hear about next, and we'll chat with you next time. Cheers.